Today, I'm going to share with you my simple 3-step swing strategy that helped me make my first $10,000 in trading profits and helped me become a consistently profitable 6-figure trader. By the way, my name is Sylvia and I've been trading for 12 years now. When I first started trading, I was obsessed with the 1-minute chart. I was glued to the screen and I would watch every single tick, hoping to make quick money and finally quit my job. At that time, I was living in Germany and every single day I would rush home through traffic at 3 p.m. so that I can trade the US stock market open. I would tell myself, today is the day, I'm gonna nail it, I'm going to catch every move and I'm going to finally make it. But guess what? Every single week I ended up with losses. And I kept thinking, maybe I just don't know enough, maybe I need to study harder and add some more indicators or try out some different strategies. There must be something I'm missing. So I joined every Discord group, I bought every course and program you can think of, hoping to find that missing piece of the puzzle. But my losses kept piling up and my ex-boyfriend, he made me feel even worse. He would ask me, how's your week going so far? Are you losing money again? It's obvious, that's an expensive hobby and it's not paying off. You need to quit that. And that destroyed the little confidence that I had left. But that's not even the worst part. Every time I logged into these Discord groups, I would see successful traders posting their gains, making thousands and thousands of dollars, being done by 10 a.m. in the morning. I wanted to be like them. But guess what? I kept losing thousands and thousands of dollars instead. I remember one Friday staring at my trading journal, completely frustrated. I was analyzing the stock Apple that I've been scalping every single day. That stock was up 10% for the week, yet I was down. And that hit me. I was like, how come is this stock up, yet I'm down for the week? If I just held that stock, I would have been green. And that was the turning point. I decided to stop fixating on the 1-minute chart and start focusing on the 1-hour time frame instead. And back then, with my full-time job, that was the perfect decision I could have ever made. No more 1-minute time frame choppiness and no more fake stop outs. I finally started catching bigger moves and stopped FOMOing every time I go to the store and leave the house. And it's crazy because that shift was so simple that I felt stupid for not figuring it out earlier. I finally became consistently profitable week after week, month after month. Now, before we start, don't get me wrong, day trading can be extremely profitable too. And in fact, the strategy that I'm about to share with you can work perfectly on lower time frames as well. The problem that I had at the beginning though was that I've been making some critical mistakes that could have been easily avoided, and that make day trading harder than it needs to be. So before we jump into my strategy, I want to share with you some of my day trading mistakes because you might be doing them too without even knowing it. Okay, so here's a typical day trading setup I would take as soon as the market opens. I would be extremely excited and I would want to jump in right away into trading so that I can catch this next big move and make quick money. And so as soon as I opened the chart, I would look at this and I would think, this looks like a nice double bottom here, and this looks like a nice wick and a nice hammer candlestick. And then I would think, as soon as it breaks the highs, I have to enter because this is a typical opening range breakout setup. And so as soon as it crosses the high, I would enter right here and I would put my stop loss right underneath and would try to catch this breakout move. But here's what would happen next. Boom, got stopped out. Unfortunately, looks like the market wants to continue further lower. So in this case, I would think bears took over. Maybe it's a good idea to wait for the breakout retest setup and just go ahead and short it instead. And so in this case, I would wait for the market to retest this zone and look for a pattern formation. And as soon as I see that, I would think this looks like a nice breakout retest setup. Let me go ahead and short that. So I would enter right here under this candlestick and I would put my stop loss above that candlestick. So here's what would happen next though. Boom, got stopped out again. It looks like the market wants to continue further higher, and I would think to myself, these are pretty good moves. I would look at the chart and feel completely stupid because I would not understand what I'm doing wrong. I'm studying all these patterns, I'm studying all these formations, adding even more indicators, and none of it is working. How come I can catch not even a single move out of this? And of course, these emotions would make me trade even more, and it would lead me to more trades, more frustrations, because I would think, well, the more trades, the better. Eventually, I would get it. But what would happen is more and more losses instead. Unfortunately, I didn't realize that I was not paying attention to the big picture, and I was trading random setups based on pattern formation and indicators. And it took me a very long time to realize that if you're not looking for liquidity, you're the liquidity. So what exactly is the 3-step swing strategy? The goal of that strategy is to help you identify high quality, high probability setups and help you avoid low quality, random moves that lead to losses and frustration. It will also help you to find the exact turning points where institutional traders are stepping in, and it will get you in the trade earlier before the move happens and before the pattern fully develops. Okay, so step number 1, and in my opinion, one of the most important steps, is identifying the market bias and market cycle on the daily chart. Regardless what time frame you're trading, the 1 minute, 5 minute, 1 hour chart, we always start with the daily chart first. The reason for that is because we are going to get some more information where institutional traders positioned. Are they more buyers or sellers? And what is the current dominant trend and cycle on the chart? The daily chart is also going to help us to identify potential stop hunting areas and where liquidity is building. We're going to use that information in our advantage. And I used to skip that step a lot at the beginning, and I ended up with tons of random setups and losses. Now let's go ahead and see what is the current market structure and how to exactly identify that. That right here is the daily chart of the Nasdaq. So you see back here, we had a very nice uptrend here and things looked pretty easy. And actually an uptrend is the easiest thing to trade. But all of a sudden we see that big red candlestick here. Now I want you to pay attention to the price action. Look what happened. The size of this red candle, it's much bigger than the size of these previous candlesticks. When we see increased range, and especially if that's on the sell side, this is an indication that there are more sellers stepping in and we might start seeing a distribution cycle. We also see here increasing of the volume. You see on the red candles, there is more red volume and increasing red volume. Again, another indication that there are more sellers stepping in. You see here what happens, very nice doji candlestick or John Wick candlestick, and then the market continues higher, but all of a sudden there is lack of momentum, lack of buyers, and it reverses to the downside. I call that failed bounce. It's failing to continue further higher and to bounce. So a typical price action of a distribution is exactly that. Big ranges, choppy price action, more volume on the sell side. We see that here as well. Big volume spike and big red candlestick. By now you should already know this is not a cycle that you want to be just blindly buying dips and not managing them properly. So when I see that, instead I would look for potential short areas and shorter term trades only. Now that we know the current bias and we know we're in a distribution cycle, we are going to look for some potential short setups and look for a continuation of that distribution and sell off. Step number 2 is finding key liquidity zones and identifying where big institutional traders are positioned. And by the way, I had no clue for the longest time why I kept getting stopped out. Every time I entered a trade, I thought it looks perfect just to watch it spike, stop me out, and goes exactly where I wanted it to go. That's when I realized that I was placing my entry orders where institutional traders are exiting, and I've been exiting where institutional traders are entering. So if you look at this chart, I want to show you real quick how stop hunting happens. If you observe the price action right here, you would see this was the low of that candlestick. It's slightly went below and the price immediately reversed and turned around to the upside. This is happening because institutional traders are not entering positions the way we do. They place a lot of sell orders around areas where they know that retail traders are placing their stop losses, exactly right here underneath, for example. They will place a bunch of buy orders around this area, and once they get filled and everyone is stopped out, then the price is going to reverse to the upside. Same thing happened right here. They were obviously more orders, therefore you see the price going a little bit further lower, and eventually after all of these buying orders were filled, the price reversed and went straight to the upside. So these are the turning points that we are going to be looking at. We want to enter around these areas and observe exactly these areas. We don't want to trade in the middle of the range. We don't want to trade random setups just because they look good. We want to trade exactly around key liquidity zones. So let's go ahead and draw these on the chart before we switch to the lower time frame. You see right here, this was the low of the day and it was tested right here. So each low of the day and high of the day is a key liquidity zone. Therefore, we want to mark that here. I'm going to draw right here a yellow line, and the high of the day is right here. We also see here another low which we want to draw in case the market drops around this area. We would know where is a potential good area to exit a position. Now that we have these, we're going to switch on the lower time frame, which leads me to step number 3, which is entering on a very specific candlestick formation I call the pitchfork. Now let's summarize first. We started with the daily chart, we identified the current market cycle and bias. We knew that we're in distribution cycle and we knew that there are more sellers stepping in. Therefore, we want to align with them and we decided we're going to be looking for short opportunities only. Then we drew the most important liquidity zones on the chart, which are typically previous highs and lows on the daily chart. Now that we know that, we're going to switch on the lower time frame. In this case, this is for me the 1 hour time frame. This is because I like trading the 1 hour time frame. It gives me a little more flexibility with my time. You can use that strategy on any other time frame. If you want to day trade, you can use that for day trading as well. So now that we're on the 1 hour chart, we see exactly what we saw also on the daily chart. Failed breakouts here, failed bounces. You see the market was trying to bounce, reversed, sold off, broke down here. Not only that, but we see increased volume spikes on the red candles and we see big range on the red candles. Again, this is confirming that there are more sellers stepping in. And now that we have the liquidity zones drawn on the chart, we are going to be looking for a very specific candlestick formation. So what I want to see here is 3 to 5-ish green candlesticks in a row in order for me to start looking for a short opportunity. The reason I want to see 3 to 5 candlesticks is because this gives me a little better risk versus reward. And also, this is in other words the so-called sucker move. This means retail traders are getting sucked in to buy breakouts and buy into resistance. We are not going to do that anymore. We are going to be looking instead to short sell around these areas because we're aligned with the big picture. Once we have these 3 to 5 green candlesticks, I want to see one red candlestick first. And typically that would be something like a John Wick candlestick, something with a wick on the top if I'm short selling. This means there were not enough buyers stepping in and the price couldn't get pushed further higher and sellers took over. So if you look at this here, this is our sucker move. This here is our lead candle. The second one is our confirmation candle. And the third one is our execution candlestick. I'm going to enter the trade as soon as the price starts going below the low of that John Wick red candle right here. As soon as that happens, I'm entering short. I'm not waiting for that second red candlestick to close, and my stop loss is placed right above. Now I'm going to show you that live on the chart so that you know exactly how that looks like. Okay, so we're on the 1 hour chart here on the Nasdaq NQ futures. These 3 yellow lines right here represent the liquidity zones of the highs and lows from the daily chart that we drew in step number 2. Now that we know that, we're looking for this very specific candlestick formation here, and I want to see the price coming into this area, which is a resistance area from the daily chart. And then as soon as this happens, I will observe the price and I will see if I get that pitchfork candlestick formation. Now, because I'm trading the 1 hour time frame, typically I would place an alarm here and I will get a notification as soon as the price reaches this area. This is for me perfect because it's going to prevent me from staring at the screen all the time and FOMOing. But if you're trading on the 5-minute chart or 1-minute time frame, it's totally fine. You can use that as well as a reference. The only difference is going to be that you're going to be trading shorter term and you have to watch the price action live as it happens throughout the day. Now I'm going to hit the replay button, so we're going to see how a good setup versus a bad setup looks like. As we can see, the price did not reach this zone at all, therefore I do not have a trade. I would not enter here at the bottom a short trade because this is very low and I'm risking that if buyers step in and start buying this dip, I'm going to get stopped out and I do not have a good risk versus reward. And these two green candlesticks right here, they're not enough for me to enter a trade. I want to see a little bit more correction. Therefore, I will wait and see if I have a better setup the next day. Now I'm going to hit the replay button again. As we can see, the price broke further lower. Now this liquidity zone right here becomes our most important liquidity zone. So the price didn't reach that one. It consolidated here and broke further lower. Now I want to see the price correcting into this area so that I start looking for my candlestick formation. As we can see, the price came all the way here to this upper zone and it shows 1 wick here on the top of this candlestick, 1 doji or John Wick candlestick. So I would like to enter right below this zone here and place my stop loss above, targeting this previous low on the 1 hour chart. Let me show you how that would look like. Okay, so I entered the trade, stop loss is right above there, and because the price starts to reverse here and we're in a very volatile type of a price action, what I would do typically is I would move my stop loss towards the break even and start trailing my stop. Now, because it starts reversing here, typically I would just put the stop right here. And if it continues further higher, I will get out of the position for a very small profit. Let's hit the replay button again. Now, as we can see, I got stopped out for a little profit again, and there is nothing I can do but just observe the current price action. If I get another opportunity around this area here, I would re-enter the trade. I do not like shorting at the bottom. Again, this is going to give me a horrible risk versus reward. Now we see here that the price stopped around this area. And as I mentioned in my rules, I want to see a few green candlesticks towards this resistance zone, and we see 1 wick candlestick. This is a John Wick candlestick, but it's not red. So I want to see 1 red candlestick first and the price going below that candlestick in order for me to be interested in shorting again. So as soon as the price starts taking this low, this is going to be my entry again, and my stop loss can be placed around this resistance liquidity zone again. So I'm going to hit the replay button and show you how that looks in real time. Now this right here was my entry and this is my stop loss, and as we can see, the market went straight through the low here. Now it is very important at this point how you manage the trade, especially in a distribution cycle. Chances are that you might get caught in a very volatile and wild price action. So I would typically trail my stop candle by candle except on inside bars. So in this case, I would just move my stop loss right here above that one as it continues further lower and it's not more an inside bar, I would just move it further, and as it continues further lower, would move it further, and so forth. This is how you can protect your gains in this volatile price action and environment. And as the price continues lower, I am going to move it above this wedge right here, because if it starts breaking out, there might be some buyers around this zone, so I want to take my profits in this case. And as we can see here, this was a very nice reversal and I got stopped out around this area. So this is how I use liquidity zones, and this is how I use the bias from the daily chart to enter on a lower time frame. I hope that makes sense for you, and I hope you can find very high quality setups next time you open the chart and use this framework. If you have not subscribed to our weekly gains guide, it's totally free and it sends our analysis on the futures and on growth stocks with fundamentals and technicals. Feel free to do so. The link is in the description box. Thank you so much for watching, and I cannot wait to see you here back on our channel again. Bye for now.